Hello and welcome. You're joining us live for the Investor Live. What are you laughing at, Gabby? I thought we got it okay that time.
We did it okay. We did it okay.
That's good. That's good. Thanks for joining us live once again. If you are here joining us live, let us know in the chat. Gavin, nice to see you there.
Hello. Good morning.
In the chat if you were here.
Good afternoon.
Also, do us a favor, by the way. Gabby and I were trying to test the audio beforehand to make sure we could get our levels right. If you think Gabby's too loud, just let us know. If you think I'm too loud, just let us know. We'll normalize our
That is rarely going to happen.
Well, I know I'm the, in real life, I'm the louder one. In real life, I'm the louder one. But I mean, it's, yeah. So it's all good.
Okay.
Liv, Matthew.
Let's go.
Great to see you guys here. We have got a big one today. So big, in fact, like this is going to come as a bit of a surprise to many of you. But like just before we were starting, I was like, holy shit, I'm not even sure I'm ready for this because there is so much, to cover in today's episode. We've got charts, we've got all kinds of stuff. Gabby, why don't you kind of give us a bit of a setup? What do we want to try and achieve out of this?
So when we were planning this episode, right, this was last weekend. And if anyone here has been paying attention to anything in the news about the economy, a lot has happened in these past 7 days. So it's been a bit of a fun journey trying to figure out, like, staying on top of everything, trying to plan for this episode and trying to bring our perspectives and our thoughts and a condensed version of like what is happening in the economy and what it means for you. So we're talking about things like tariffs and trade wars, and are there tariffs? Are there not tariffs? What does that mean for Australia? What does that mean for our economy? All those kind of things. So, yeah.
Okay, so we'll do our best to kind of cover off all of that because there is a lot going on. I mean, in the last week or so, we had the largest 2-day decline in the US stock market since the GFC, which is pretty massive, right? And so evidently there's a lot going on, and evidently that has caused a lots of turmoil and turbulence in the markets, and that extends into all kind of reaches, right? So you don't have to be invested in the stock market for this to affect you, right? So what this does, this has effects everywhere. Now, I'm going to kind of start with my kind of high level point of view, and then we can kind of walk through a bunch of stuff. How does that sound?
So yeah, awesome. I'll actually just highlight to Josh. Hey, Josh has mentioned, glad I'm not the only one drowning with info and trying to plan out how this is all going to play out. Totally agreed. Like, it's, like I said, so much happening this week, so much to try and stay on top of, and it can be very confusing. So, all right, Goose.
Yeah, totally. Okay, so look, my high level point of view is that the reason the market's crashed, and look, this is not, some of this might not be revolutionary to you guys, but we've got a whole bunch of charts and stuff that I'm going to walk you through. My high level point of view is that the reason the market's tanked is because of uncertainty, primarily, right? So the tariffs came into place. There was a whole bunch of confusion around it. The formula that was put forward on how they calculated the reciprocal tariffs kind of didn't make sense. Even when Trump did the announcement, he held up a trade imbalances chart, implying that actually what he was trying to do was trying to get trade balances back into check. So there was lots of confusion, and markets hate uncertainty, which is why markets crashed, because everyone didn't know what was going on. My point of view is that overall, the tariffs are going to be deflationary, and I'm going to walk through some charts around that. And I think the big story here is China and liquidity, and this is kind of what I want to walk people through, because I think this is the story that's not being told. Everyone's kind of like, oh my god, we're all going to get taxed more, or everything's going to become more expensive, or tariffs are going to be inflationary. Hey, Braden, nice to see you here as well. There's all of this kind of stuff, and I think that there's actually just a different lens to view this through. And if you can view it through the lens that I can view it through, you'll probably recognize that whilst there is a lot of volatility, and whilst there may be some short-term pain, we should all be thinking with fairly long-time horizons anyway. If you can kind of see the world through my lens, I think you might actually see that this is actually going to be net positive in many ways as this plays out. So
awesome.
With that kind of a setup, why don't we just jump right into it?
Yeah, awesome. I also just want to say, like, with all of this, whenever we talk about new stuff, I feel like you and I, it's our function as commentators on this. It's just to try and help people to not panic, right?
Yeah.
Because I think no matter what happens, like you're saying, markets don't like uncertainty. People don't like uncertainty. And so when things are uncertain, people panic. And it's, if we're investors, we might see opportunity and we panic that way and we make the wrong decision. Or if we are not investors and we're not educating ourselves about this, we panic and we act in other ways that are not so good. So all of these conversations about trying to make sure that you, if you're listening to this, don't panic and make the wrong choice, because it's when you actually act that's when your worries become real, right? If you're making the wrong decision, you can worry and worry
Yeah.
and worry, but if you don't take the action, when you act on something, that's when you're crystallizing your beliefs, and all of your knowledge is coming into fruition at that point. So
yeah, 100%. You never want to react to markets, right? I have a phrase that I like to roll around in my mind, that the day-to-day gyrations of the market are not of my concern, right? So really what you want to do is you want to develop long-term conviction in different assets and why they're going to move in certain ways. And then when things get volatile, when things get a bit weird, you can kind of look back and go, okay, has my thesis changed? Has something like fundamentally changed about this? If not, well, then shut up and move on and stop looking at the numbers, basically, right?
Yeah.
And you are right that, in these scenarios, you only crystallize your reality when you act.
Mm-hmm.
And so if you act in haste and out of a kind of emotional reaction, you may crystallize the wrong reality for yourself. So I think that's a good point. Okay, so I encourage everyone to ask questions as we go through this. There's a lot to cover. I'm going to be sharing a bunch of charts, and we're going to be walking through what I think about these. Gabi, I want you to try and be the wonk filter, wonk with an O. And what I mean by that is some of this stuff is going to be a little bit nerdy and a little bit
perfect.
A little bit kind of complex. And so if I don't explain things well, can you kind of act as that filter to kind of go, well, what does that mean, and why would that mean that, or something? And I'll kind of
perfect.
Explain it.
Yep.
And for all of those in the chat, feel free to ask questions as you go. I'm going to be paying attention to the slides and a whole bunch of other stuff, but we will try and get through questions as well. Cool.
I'll hang out with the chat. It'll be me
All
and these guys watching you.
Perfect. Okay, I'm trying to share my screen. Is that coming through? All right, cool. So we've got a few things that we want to walk through here. So first things first, we need to think about the setup. Now, by the way, a bunch of the charts that I'm going to be showing, some of them I've taken from TradingView and some of them I've pulled from other sources. This is actually from GMI, or if anyone's familiar with Real Vision, they'd be familiar with a chart that looks like this. So the setup here is actually really not tariffs. The setup here that we really need to understand is what is happening with the US economy, what is happening with US sovereign debt, and why are they making the moves that they're making. So in the first instance, what you can see here is the US labor force participation rate is tanking. And on the right-hand side of this chart, you've got the US government debt as a percentage of GDP. So what you can see is those two things are highly correlated. Now, what is GDP? GDP can be defined in a bunch of different ways, but it's broadly made up of a combination of demographics, debt, and productivity, okay? Now, what we can see here is that the US labor force participation rate has been going down, which means that there's less people actually active in the workforce. And so what has been happening in the US as a proxy to paper over those cracks, the gaps in the US labor force participation rate, i.e. less people working, less people paying taxes, less people productively contributing to the economy, they've been increasing their debt. Now, that
Just
level
quickly,
of go on.
Just quickly, so labor force meaning it's declining because older generations are retiring.
Correct.
And,
Aging population, primarily an aging population, right? So we have the baby boomers are retiring, all of that kind of stuff, and we have lower birth rates, which means that this trend is actually structural, right? So this is not a temporary trend. This is a structural trend. And what I mean by a structural trend is that globally we have declining birth rates, which means perennially we have an older generation, which means we have more people retiring than entering the workforce on a kind of year-to-year basis.
Interesting.
On a typical kind of trend basis. Now, what I would also point out here is the US is actually better than lots of other parts of the world. Look, Australia's labor force participation rate is actually pretty high because we just import all of our labor, right? So we've got a massive migration program. So Australia's labor force participation rate is pretty high, but that's just because we just like open the spigots and shove as many people into the country as we can, and that creates a whole bunch of other problems, right? And just for the avoidance of doubt, I'm pro-migration because I'm pro people being able to move and live wherever they want, and I'm pro inclusivity. Not to say that the Australian government hasn't kind of maybe overcooked it with the amount of immigration that has been allowed to happen over the last few years, because I think it's put too much strain on the system. But the
Yep.
US labor force participation rate is actually way better than, say, Europe, right? So this is actually pretty good. And part of the reason for that is because generally the US economy is still seen as a desirable place to be. So they have a lot of immigration. They have a lot of people trying to get into the market there to be able to work there. And so that centralization as the US as being a desirable economic force means that people go there, and that kind of props up the labor force participation rate. That has counteracted some of the aging population, but nonetheless, that is a really, really steep decline. Now, what the most interesting thing, and this is kind of like, if you can underpin just one thing, this is really the story. Because what's happening is the US debt to GDP is skyrocketing. Why? Because the labor force participation rate continues to collapse. Yes, we did see a little spike up there after COVID because, there was older people returning to work and a few other bits and pieces like that. But in a very kind of general sense, it's a strong downwards trend, and it will continue to go that way. So when you think about that and you recognize that they're using debt to effectively stimulate the economy through government spending and all of this kind of stuff, that stimulates the economy, that stimulates the GDP, that papers over the cracks of the fact there actually aren't as many people in the economy working and making revenue and making productivity. Does that make sense?
Yeah, it does. Yep.
Okay, so this is functionally a major driver of why US debt is increasing so much. Now, you can see here US debt to public debt to GDP, so government debt to GDP, is currently at about 123%. It actually shot up to about 130%. You can see that spike just after 2020 there, and it's come down a little bit, but it is trending back upwards again at 123% debt to GDP. Now, for context, that is very, very high. I think, and don't quote me on this as fact, but I think I heard a stat a little while ago, and it was something like 5 out of the last 6 times a government has gotten to 130% debt to GDP, their economy has collapsed completely. So
Mm.
getting to that level of public debt to GDP, I think Australia's public debt to GDP, and again, don't quote me on this exactly, I think it's like around 40, 50%, so it's significantly lower. Our total debt to GDP is about 250%, but public debt to GDP is the real story here, because actually what we've got to consider is we've got to consider interest rate payments on that. So, go
Quick
on.
question. Could you just, I don't want to go too far into like all the definitions of things, but like
Fine.
GDP,
Yeah.
what does that actually mean? Like, why is it important to measure GDP against the level of debt?
Yeah. So GDP is the productive output of a country,
Hmm.
right? So GDP is a measurement of the output of goods and services in a country, the amount of value that is being created by the country, right? So
Yep.
it's not the same as revenue. It's not the same as revenue. It's not. But as a measure of productive output or value creation, that's where that kind of comes in. And so measuring this is really, really important, because if you have too much debt versus your GDP, your interest payments are going to be too high. They're going to become unserviceable, and it's going to start to fracture and weaken the economy. So, if you go back to like 1980, the debt to GDP was around 30%. And by the way, there's going to be 3 major economic forces here that we're going to be talking about all through this. We're going to be talking about the US, we're going to be talking about China, we're going to be talking about Australia. So we're going to go through a few of these things. You might be like, why are we talking about the US? It's because it all starts in the US, because it's the largest economy and it's the global reserve currency. So this is why we need to start here. So the story here is that their debts are skyrocketing, are out of control. And I think interest payments have become something like 30% of all tax receipts or something like that. It's crazy,
Wow.
right? So it's becoming unsustainable, and the US is teetering on the edge of a sovereign debt crisis, which is in fact why the Trump administration, and look, this is not a political statement. You can think whatever you want about Trump. I'm just going to talk about the kind of economics of it all. So their main mandate is, how do they lower interest rates? How do they increase liquidity? How do they start to improve the GDP output? Because there's 2 ways to change the balance of the debt to GDP ratio. Number 1 is increase the GDP, and number 2 is decrease the debt. Now, if the cost of debt becomes cheaper, then it's going to become easier to service and easier to pay it down. And if GDP grows through growth, then that ratio will change. And if debt to GDP will go down, then that's going to be good for the economy, and that's going to be good for the government. Make sense?
Yep.
Cool. All right. So the thing about this, right? So US public debt to GDP is at about 123% at the moment. Now, what you'll notice here by looking at this chart is that the white line is US interest rate, so the cash rate, so the Fed funds rate. Sorry. And the red line is debt to GDP. And so what you'll notice is the that it shot up in 2008. So they started really cranking up the volume of debt versus the GDP in 2008. But you'll also notice around that time that the interest rates, so interest rates are on the right-hand side and debt to GDP is on the left-hand side of this chart. You'll notice that the interest rates, when they were starting to crank up most of this debt, were extremely low, basically almost at zero, like less than 0.5% cash rate. So they were able to load up on really cheap debt, right? Which then allowed them to stimulate the economy, which allowed them to on paper to kind of paper over the cracks of a failing labor force, a failing economy by stimulating it with government funding, right? It was stimulated with government spending. That has then that debt needs to be rolled over and that debt needs to be paid. So the way that works is there's bonds that get issued. They're effectively debt notes and stuff like that. They then need to be rolled over and refinanced, and other debt sources need to be rolled over and refinanced. Now, the interest rate now is way higher than it was throughout the most of the debt accumulation. So they're now faced with the situation that the interest rates are really high, and if they roll over the debt onto higher interest rates again, they're going to be stuck with these really high interest payments for a really long time, and that's going to potentially fracture the economy. Make sense?
Yep. So they're working towards pulling the cash rate down, basically.
Well, this is the objective, right? So they need to be able to lower the interest rate so that they can afford to continue to service the debt. Okay, so because if we look at this chart here, this is US total liquidity is the black line, and you'll see how closely it tracks the federal government current expenditures interest payments with a 33-month lead. Now, the 33-month lead is just really the time between the liquidity gets created and gets distributed into the interest payments. What you'll see, that's a pretty close correlation. And if nothing changes, then what's going to happen? You can see where the interest payments are going over the next few years. They're going to go up to $1 trillion of interest payments, right? And so what will necessarily have to happen is liquidity would need to rise up as well. So they need to they need to do two things to make the situation better: lower the interest payments so they don't get up to $1 trillion of interest payments, right? And also increase liquidity. Because if they can increase liquidity, then they can afford to make the interest payments. But if they lower the interest payments, they don't have to increase liquidity as much, which means they don't have to devalue the currency quite as much. They don't need to print as much money. Does that make sense?
Yeah, it does. What I find so interesting about all of this, obviously it's all very interesting, but as an investor, if you are aware that all of these countries act as their own business, right? And that's what I
Yeah.
think is so interesting about everything Trump's doing, is like he's thinking about it all like a business. Now, Goose, you're still sharing your screen.
Yeah, something happened there. Sorry. Apologies.
It's all right.
There we go.
All good. Yeah, he's approaching this like a business, and I think if we're as investors kind of realizing that all of these countries make these moves as though they are business, they have their own balance sheets, they have their own profit and loss statements, they function in a way that can help to propel their individual business. And I think that's what's so interesting about what's factoring in here. It's like all of these competing forces for how do I improve my business as a country.
Yeah, totally. Right. And so there's other factors, and thinking about it from that perspective, currently government expenses massively outstrip tax receipts, right? So they're basically spending more money than they bring in on a yearly basis. They're running a massive deficit. So there was all the Elon Musk Doge stuff, which seems to have kind of been fizzling out a little bit. But the idea there was like decrease costs, right? Decrease expenses. Yep. That's one piece of it. There's decrease expenses, but one of the biggest expenses they've got is the interest expense. So how do you decrease the interest expense? You've got to lower the interest rate, right? Then also, and it's also like how do you then grow the economy? How do you create more income? So the tariffs are a function of trying to create income, and also by proxy, they want to be able to lower taxes as well, which makes then the US a more desirable place to be. So this is all a function of how do they manage the sovereign debt crisis that they're facing. Really, this is the primary thing they need to work out how to solve. Because if you look at the distribution of US government expenses, it's mostly interest, social security, and defense, and then the rest of it is like pretty much a rounding error, right? So yeah, can trim a little bit out of like some of the small discretionary spending stuff, but the fact of the matter is, unless they're going to cut massively in defense, and the US has been going around banging the drum and kicking people and throwing rocks at people for a long time now, probably not a great idea to start defense, although I'm sure there's a ton of wastage happening in defense. Social security, if they were to go and cut everyone's social security, welfare, all of that kind of stuff, they'd be crucified. They'd never be elected again, right? So they're not going to do that.
Yep.
So then how do they tackle the interest expense, right? This is the biggest issue. And again, at the
And
moment,
people and people like the idea of interest rates coming down.
Well, totally, right? So this is good for, it stimulates growth. Now, you got to remember that Donald Trump is we'll call him a stock market president, right? Because he measures his success on the success of the stock market, right? And so whilst it may not seem like it now because he's tanking the stock market, I believe that what he's doing is setting up for a scenario to create greater liquidity, lower interest rates, and more growth, right? And now the midterm elections next year. And so I think that basically right now what he's doing is a whole bunch of stuff which is causing a bunch of pain so that they can get into a position to dictate how the financial conditions are going to shape up moving forward. So by the time it gets to the midterms, everything's roaring and everyone's happy and everyone thinks that he's the best guy in the world and he gets kind of reelected in the midterms. Now, I don't really understand the midterms thing very well. I don't get why there's like some kind of like second election. There was some shit that goes on there. So don't ask me about that, but I know that it's important to them, right? So this is a big thing here. So by the way, guys, in the chat, let us know if this is tracking, if this is making sense to you, because just to kind of go back a little step here. So US labor force participation rate is tanking. US debt is increasing to paper over the cracks of the economy. US debt is at an unsustainable level. It's causing interest payments. And because interest payments have risen, that means that the interest payments are now taking up a significant portion of government expenditure and government income. Therefore, it's becoming unsustainable. And if they don't solve this, they're in the process of trying to raise the debt ceiling again. If they don't solve this, they're going to be spiraling into a sovereign debt crisis, which could collapse the entire US economy. So this is really the story here. And by the way, and then this is an indication of where interest payments are going if they don't get the interest rates down. And so there's a combination of lowering interest rates, raising liquidity, and kind of like stimulating the economy, which is going to bring that back in line and make that sustainable. That'll increase the GDP, lower the debt to GDP ratio, increase the liquidity available to pay the interest, lower the interest repayments, and therefore bring those two things back in line. Increasing liquidity and lowering interest payments is basically like if you get a mortgage rate cut and also get a pay increase in your job, well, guess what? Your mortgage is it's way easier to pay your mortgage, right? That's the easiest way to think about how those two things kind of come together. Increasing the liquidity or increasing the money flowing around the system at the same time as lowering in interest rates is going to bring that together in a way that it becomes more sustainable and easy to pay. All right, awesome. Cool. So let's go. All right. So basically, right. Go on.
Sorry.
Yeah, okay.
All of that was the setup. So that's like setting the scene for kind of what's been happening this week. It's to give like the first scene in a movie, you get a lot of context about the background of a character and where you are in the world and what's been happening. You get the backstory. All of that was to set the scene of like, okay, now that this has happened this week, hopefully this makes a little more sense, right?
Well, yeah. So this is the background. This is why. Okay. So this is the problem that they're trying to solve. Okay. The problem that they're trying to solve is they're spiraling into a sovereign debt crisis. Okay. So then tariffs got announced, right? And everyone's like, oh my God, tariffs got announced. Tariffs are going to be inflationary. Oh my God, it's terrible. This is going to be the worst thing in the world. But in fact, here's where people get it wrong. Now, in the first instance, I'll explain where they get it wrong in a second. In the first instance, they introduced the tariffs. The whole market, excuse my language, shit themselves. You can see here, this was as at yesterday. So these numbers, all of the data is going to be as at yesterday because I was putting these together last night. So some of these numbers are going to have changed today, but this is the world we live in. So you can see here over the period of, you can see my mouse. That's cool. Yeah. So you can see here, we went from on April 1st, 19, which is still extreme fear. We got down to 4, which is basically like you almost can't go lower than 4 on the 4th, 7th, and 8th of April, which is pretty crazy. And then we popped back up when we had that kind of like 20% jump in the stock market the other day when they said they were going to do a 90-day tariff pause. That jumped back up to 15, but only to 15. If 15 is extreme fear. So what you can see is the market is in a crazy panic over all of these because of the uncertainty. This is what's caused, and that uncertainty is what's caused stock markets to crash. That's caused people to go, okay, what do I do now? What's happening with my money? And that's been the kind of major source of pain. Now you can see here, this is the S&P volatility or S&P VIX index. You can see here, basically it's a measure of how much did the stock market move in a single day? What was the volatility? How much did it move? And you can see here that it was basically the third highest S&P volatility since 1990. Now, technically, you might argue fourth if you count like this kind of like little repeat spike back up in here during the GFC, but I would class that as kind of like one primary pillar. So you've got COVID sitting here, you got the GFC, but even in the dot-com bust, the VIX didn't go that high. And this is a rate of change, by the way. So what we saw in the last week was pretty historic. It's right up there with COVID and the GFC in terms of how much of an impact this had. And you can also see this in the Chicago Board Options Exchange. Now, this measures options volatility over the period, which is interesting because the options market is actually several orders of magnitude larger than the equities market. So there's several quadrillion dollars in derivatives that are floating around in the options market, which is more than the value of all economies on the planet combined float around in the derivatives market. So that's why it's interesting to look at options volatility, because it kind of gives you a point of reference on how the kind of broader environment is looking. And you can see here, it's the third highest options volatility since 1990 as well. Now, why 1990? It's just because that's how far back the charts went. So again, this is pretty historic. So this is an indication of how much emotion has been driven into the market through this uncertainty. You got any questions on this, Gabby?
No, I mean, I love seeing the fear and greed stuff because I just think it's a beautiful summary of what we all feel, like being able to see it. And obviously there's measurements that go into these numbers, but
yeah,
like that tracks with what's been happening this week. And this is a constant score that's happening live, right?
Yeah, totally. Yeah. We could go check it now and see what it is. And it's going to be some it may even have gone back down again because we had a bit of a dip in the markets again today. So tariffs got introduced, right? Everyone freaked out. Everyone assumed that tariffs would be inflationary. Everyone assumed that would mean that rates would go higher. Everything would crash into a recession. Now, I actually haven't got any charts in here on recession. I just didn't get to it. But everyone's talking about recession. We'll talk about that a little bit. But we've been in a recession for like 2 years. Like I think we've had 8 quarters in Australia where we've had rolling per capita recession. So, this is not the start of a recession, in my opinion. This is the end of a recession. So I think everyone needs to get their head around that.
No, this is really interesting because I think because it has been a very tense few years economically just around the world. And so I think everyone's kind of been waiting for a recession. And so I think everyone's just waiting for some kind of signal that it's about to crash because we're all just like on our seats. Like, of course, a recession's about to happen because people may not understand that potentially we already have been in one. And I know a lot of like popular economists are kind of stating that we have actually already been in a recession. It just hasn't been displayed in the same way that previous recessions have been displayed, right?
Why? But why? So this is the important thing. The reason is because of government spending. So even if you look in Australia, so Australia's been, I think there was definitely 7 straight quarters of a per capita recession in Australia. There may have been an 8th. I'd need to go and double check that. If we've had 8 quarters, right now, 2 quarters of GDP, negative GDP or GDP decline is considered a recession. 8 quarters we've been in a per capita recession, right? It's for 7 or 8 quarters. That's crazy. Now, why haven't they said that? Well, 2 things. Number one, they imported a whole bunch more people that contributes to the GDP. And also they started spending, the government spending went through the roof as well, right? So then again, you've got this situation where government liquidity has been papering over the cracks of the economy. We've actually been in a recession for the last couple of years, but they just keep spending. And that's why Australian government deficits have been so high. That's why and look, this is not a political statement. I don't care who you vote for, but that's why the current government has run it into such a massive deficit. That's why they're saying they're not going to get back into surplus for like 10 years or 20 years or whatever the number is. They're like, oh yeah, no, we've got a plan to get back into surplus in like a decade. It's like, well, why? Because they've been spending so much money. Even the RBA said, we'd love to cut interest rates, but we can't because the government keeps spending too much money, right? And they kept propping up the economy. So this is actually the problem with government spending and governments increasing their debt. So, which is what the Australian government has been doing as well. So this, and it's been the same in the US, it's been the same everywhere. There's been sector-based rolling recessions. So there's been recessions in the commercial. Look, there's been a recession in the commercial property market since 2020, when everyone decided to go work from home. Like, there's been recessions in various parts of the economy, but we've been just rolling through it. Now, one of the things, and I've said this before, is I don't believe that we'll have significant and sustained recessions ever again, or even depressions ever again, because governments have worked out how to push the money printer button. And that's effectively what they've been doing for the last 2 years as well. That's exactly why property prices have continued to go up, even when interest rates went up, even when cost of living has gone up, because they kept hitting the money printer button through the function of credit creation and government deficits in Australia. Same thing's been happening in the US. Now, and that's also why their debt has spiked so high, and that's also why they're facing a sovereign debt crisis. Okay, let us go back to it, because I want this is really interesting. I want to talk about. So am I still sharing my screen? Can you bring my share screen back up,
You are
please?
now. Yep.
All right. So here's what everyone has gotten wrong, in my opinion, about the tariffs. So everyone thinks that tariffs are inflationary, because what they think is, oh, so my thing that I want to buy is going to cost more. And whilst that is inherently true, because tariffs are not a tax on foreign countries, tariffs are a consumption tax on the individuals within that country. That's very important for everyone to understand. Okay. If you're a US citizen and there's a 25% tariff on Australian beef, that means that if you're a US citizen and you want to buy Australian beef, it's going to cost you 25% more to buy that Australian beef. It's not going to cost, like, no one's going to tax the Australian farmer 25%. No one's going to tax the Australian government 25%. It is a consumption tax for the individuals of that nation to pay at the point of consumption or point of purchase. Okay. So yes, it is true that tariffs will make prices go up on some items. However, the second order effect of that is that what happens is global trade slows down. So what I've got here is I've got a chart of the Dow Jones Industrial Average Index around the time of the Great Depression. Now, I actually don't have the dates on the bottom, and I do apologize for that. But in 1929, the Great Depression started. Why did the Great Depression start? The Great Depression started because there was parabolic market exuberance in the stock market. That was fun. That was driven by a lot of speculation, a lot of people getting leverage. There was, like, I think the average margin rate was about 90% on stocks. Like, it was pretty crazy. And so the market got overheated. Everything started to careen out of control. And then the US Fed raised interest rates and tanked the market. Basically, they raised interest rates. That caused the stocks to collapse a little bit. People were so leveraged that they got margin called. That was then forced selling, which then forced the market to collapse even further. Now, what's interesting here is you can see at this point right here, it started to recover. Then at this point right here, there was the introduction of a thing called the Smoot-Hawley Act. Now, I'm going to jump ahead a little bit. So the Smoot-Hawley Tariff Act was put in by President Herbert Hoover, and it was designed to bring more productivity back into the US. That was the idea. You know what? We're going to make America great again. We're going to bring all the production back into the US. We're going to tax everybody else. We're going to do all of this kind of stuff. It was intended to bolster domestic employment and manufacturing, but instead deepened the depression because the US's trading partners retaliated with tariffs of their own, leading to US exports and global trade plummeting. And so what actually happened is it has been cited as the primary reason that this went from a recession to a depression that lasted several years. So this actually tanked it. Now, what this is deflation. That's what that is. Right. And so the introduction of tariffs caused massive deflation because of the reduction of global trade, the shrinking of economies, the loss of jobs. Right. And that actually caused deflation, not inflation. Right. Because inflation is the expansion of productivity and money. This was deflation. Okay. And so this caused a massive deflationary effect. That's what caused the depression. Now, the bounce off the bottom here was caused by Franklin D. Roosevelt getting elected right around here sometime, and they called it the hope trade because he came in. He said, "I'm going to make all these reforms. We're going to do everything. We're going to make America great again in a different way." They all say the same thing. And then right here was the introduction of a different act, the Reciprocal Tariff Act. Now, the Reciprocal Tariff Act was actually a counter policy to the Smoot-Hawley Tariff Act, and it basically said, because during the Smoot-Hawley Tariff Act, the average tariffs globally went to about 60%, I believe. from memory.
Wow.
And so but yeah, it was crazy, right? So it just shut down global trade everywhere, right? It was terrible. The Reciprocal Tariff Act said, you know what? Hey, let's liberalize trade again. Let's open things up. Let's have conversations about it. Let's talk. Let's be reasonable. Let's lower the tariffs, and let's make, okay, if you're going to tariff us on a certain thing, we'll tariff you on the same thing at the same rate, sort of stuff, right? It was like, let's just simmer down and pull back. Now, the impact of that was that you saw sustained and protracted ongoing growth, and that is economic inflation, not deflation, because what actually happened is global trade started to proliferate, more goods and services flowed around, that created more opportunities, that increased the velocity of money, all of this kind of stuff, because more economic stimulus was happening through the totality of global trade. Does that make sense?
Yeah, it does. It's I'm just thinking through, like, again, think whatever you want about Trump, but it's like he has a very nationalist approach with everything that he's doing, right? Because I think with these kind of acts and how the world, since here without huge tariffs, it's been very uh, agreeable between everyone of like, okay, we're not going to freak out and charge everyone each other massive tariffs because we're all in this together, kind of a collective approach to it. And I think what Trump so far, what we've heard in his policies and strategies, it's like, it's very much like, I want to make America great again, obviously, but make them the superpower that they were, that what they once were. And it's doing
Well,
much more of a nationalist, we're going to beat everyone else.
I'm not sure. I'm not sure if I agree with that. Right. I think that he's got one singular focus. Right. I think he's got one singular focus, and that's fix a failing U.S. economy. If the U.S. doesn't fix itself quick, it's going to collapse, and he can see that. Right. And so, how do you fix the economy? Well, you're going to have to weaken the dollar. You're going to have to increase global trade. You're going to have to stimulate the local economy through genuine means, by not just increasing the debt. Now, the, let me keep running through this, because I think there's a few interesting points in here. So everyone kind of has suspected or reacted in a way that tariffs are going to be inflationary, and that's going to mean the interest rates are going to go up again and all of this kind of stuff. And oh my God, this is going to be terrible. And that's largely why the stock market crashed. But the reality is that evidence has suggested that tariffs in the way they've been implemented, in the way that Trump has put them in the last couple of weeks, have been deflationary. And also, by the way, we are moving into a deflationary environment, right? And this is kind of one of the big points that I want to make here. M2 velocity has been slowing since kind of mid 2023. So you can see that on the right hand of the chart here. M2 velocity and this is US M2 velocity, by the way. M2 velocity is the speed at which the M2 money supply in the US is moving around the economy. Slower means more, so there's two terms in here. There's deflation and disinflation. Deflation means negative inflation. Disinflation means inflation that is slowing down, right? So it's still positive inflation, but it's slowing down. So M2 velocity slowing is a disinflationary signal that points to inflation coming down, okay? And if inflation comes down, what that means, so if you just kind of think about this for a second, central banks increase interest rates when inflation goes up. When inflation goes down and you move to a disinflationary environment, that's bad for the economy, because if you have a disinflation environment, your debts actually cost more tomorrow than they do today. And so what they need to do is they then need to stimulate. So we're already on a disinflationary trend. We have been since from a M2 velocity standpoint. This is then being exacerbated by the proposed or the theorized introduction of tariffs. Now, the reason I say that is because a lot of this stuff, I think, is market manipulation, for lack of a better term, or market posturing, or geopolitical kind of posturing, to get to the outcome that Donald Trump wants, which is the ability for interest rates to be lower and liquidity to increase, as we mentioned at the start, because that's the kind of key driver. Now, I'll talk about the Mar-a-Lago Accord and the Shanghai Accord a little later, but what we can see here is, again, tariffs, deflationary, M2 velocity slowing, that's a disinflationary signal. The US official inflation rate, you can see it's come down since July 2022, where they said it peaked at 9% and is now at 2.81%. What's most interesting to me is trueflation. Now, this is a non-government measure of, because what happens with the government measures of inflation is they manipulate the baskets of goods and services they consider in CPI based on a variety of things to kind of manipulate the data in the way they want, right? So it's very unreliable data. Trueflation is an independent blockchain-based measurement of consumer prices over any period or over the period since they started. So you can see in as far as the Trueflation index, which is generally believed to be a much more accurate representation of US inflation. Now, they don't have a Trueflation index for Australia yet, but I believe they will create one. You can see that it got to nearly 12% actual real inflation in the US in 2022, 2023, and it's now down at just 1.34%. Now, the target band for the Fed is 2 to 3% inflation. If it goes lower than that, then you have a disinflationary, potentially trending towards deflationary environment, which would then necessitate government stimulus in order to stimulate the economy back on track. Because if you have deflation, then you end up with a situation like the Depression, which they don't want. Now, and by the way, if you want to understand a little bit more about how money works and why all of this kind of stuff matters, go back to the first episode we did this year, and maybe Gabby, we could link it into the notes. What is money? And also the second episode where we talk about liquidity. This is good. There'll be great points of reference for you to kind of go back over and understand all of this kind of stuff. So if you have economic deflation, then the cost of debt in the future, it costs more than it does today because your dollar in the future is worth more than it is today. And if you have monetary inflation, then your debt in the future is worth less than it is today, so it's easier to service. So if inflation gets too low, then the government will be forced to stimulate. You can already see here, by the way, the GMI Financial Conditions Index. So this is, I robbed this chart off somebody else, is really interesting. So the GMI Financial Conditions Index is a formula that includes interest rates, bond market signals, the US dollar or the DXY, the dollar index, US dollar index, commodities, credit spreads, and equity volatility. And this tracks on a 4-month lead using those indicators, able to develop a 4-month leading indicator. Now, what this is showing is that financial conditions are trending massively upward, which means we're starting to move into a higher liquidity, higher stimulus, higher growth, more active part of the business cycle. And Trueflation has tanked to down to less than 1.5%. Okay, so we've got real inflation is actually really low, and financial conditions are starting to accelerate. The other story here is the dollar, the US dollar, because if the US dollar is too strong, then we again end up with a scenario that is known as the dollar wrecking ball. Most global debt is denominated in US dollars, including China's debt, and this is very important. I'm going to come back to that. 50% of China's debt is US dollar denominated debt. And so if the dollar is too strong, that sucks liquidity out of the global market because the debt needs to be repaid in US dollars. And if every other currency is getting weaker versus the US dollar, it requires more of the local currency to be able to service that debt, which then sucks liquidity out of those economies, which destroys productivity in those economies, which then grinds global GDP down, sucks liquidity out of the market, all that kind of stuff. So it ends up being very negative. Now, what's interesting about this chart is it overlays over Trump's last term. Now, in 2016 to 2018, so around January 2017, when Trump got into power, he basically said the dollar is too strong and he wants to weaken the dollar. Why does he want to weaken the dollar? He wants to weaken the dollar because a weaker dollar means more global liquidity, more trade, more an increased velocity of money, all of this kind of stuff. It's going to stimulate the stock market. It's going to stimulate US equities. It's going to stimulate the US economy because most of the money flows into the US anyway. So he made the statement then that the dollar is too strong. Now, what's interesting is he's effectively doing the same thing this time around. And you can see how closely the Dixie is tracking versus his last term in office. That's a pretty indication of where this is going. Does that make sense, Gabby?
It does. I actually just want to touch on, Olivia's just sent through a question that I will pull up and read out. I hear you on the short term that this is deflationary. However, doesn't deflation most of the time cause inflation as they need to print us out of it? Therefore, long term, we're still heading into inflation?
There's different types of inflation. There's consumer price inflation. Then there's monetary inflation. There's probably a few other ones as well. And Olivia, you're 100% correct, right? So when you have economic deflation, the way they get out of it is monetary inflation. And we saw that happen with COVID. And this is the whole story, right? So Olivia, you've jumped to the punchline, but this is the whole freaking story. Everyone is freaking out thinking, oh my God, the economy is going to crash. We're going to go into a depression, yada, 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 all that kind of stuff. The fact of the matter is what we can see here is dollar is weakening. They're making moves to force interest rates to go lower. They're making moves to kind of basically tank a whole bunch of stuff so that they can stimulate to grow out of it. So monetary inflation wise, Yes, that is actually the big story here that is unfolding. And I'm going to keep walking through this because some interesting stuff to understand. So,
Mm.
yeah, you are 100% correct. By the way, I don't believe that tariffs will be, tariffs may stick around, but I don't think they're going to stick around in the same way that they are proposed at the moment. So dollar is weakening. And also, this is another deflationary indicator, is crude oil prices are plummeting. Now, crude oil prices are a proxy for energy and production. The cheaper that oil is, the less production there is, or the lower the cost of production. So lower oil prices are a big deflationary signal as well. So we can see here, dollar is going lower, oil prices are going lower, inflation is going lower, financial conditions are rising. So we start to see that actually things may not be as they're getting shaped up in the media. And the real story here, I think, is China. And this is the thing that everyone's missing. Everyone thinks that this is a US story. Everyone thinks that everything that's going on is Donald Trump. He wants to tax everyone else with tariffs, and he wants to do all this stuff. The real story here is China. China's economy is in big, big trouble. And Donald Trump knows that, and the rest of the world knows that. And there's a couple of outcomes that can happen here. And I believe that everything that we're seeing playing out in the media is geopolitical, geopolitical maneuvering. And I actually believe that a lot of this is being has already been agreed to and orchestrated, and everyone's just in a position where they're just playing strongman. So let's have a look at this chart first. So this is the China M2 money supply. You can see how much that's grown since 1996, 5,388%. Versus US, only 494%. Australia, M3 is not the same as M2, but it was the best proxy that I could get, 926%. So just have a look at how much money printing has happened in China over the last, whatever that is, 30 years, basically. It's insane. Now, that is one thing, but then you've also got to look at what has their GDP growth been like. Now, in this chart here, GDP is referenced in nominal terms, not year-on-year growth terms. It's very important to understand because I'm going to talk about this differently in a second. If your GDP grows at the same rate that you print money, your currency doesn't devalue, because the value of your currency is effectively the value of the goods and services and assets within your country divided by the total amount of money supply gives you effectively the value of your currency. And so if your GDP is growing, so the value of goods, services, and assets within the country is increasing at the same rate that the monetary supply is increasing, then your currency doesn't devalue. What you can see here, though, is money printing has gone through the roof and GDP has grown very, very, been one of the fastest growing economies in the world, but hasn't grown as fast as money printing. Okay. Which is why over the last 30 years, no, that's not why, but here's another point of view on the GDP. So the Chinese year-over-year GDP growth rate has been declining over the last 30 years. So this is in nominal terms, this is in year-on-year over growth terms, over year-over-year growth terms. So you can see that the Chinese economy is slowly but surely grinding downwards in its output. And that is not a good thing. So their economy is really struggling. They've been printing money out the wazoo. They've been printing money faster than nominal GDP growth. Year-over-year GDP growth is declining. And as a result, the Chinese yuan to USD exchange rate is the lowest it's been in 17 years. So that basically means that the Chinese currency is devaluing against the US dollar. Now, why is that a problem? Well, the reason that that's a problem is because if the Chinese yuan collapses in value against the US dollar, what's going to happen? Well, firstly, there'll be a capital flight out of the US, out of China. There'll be a capital flight out of China because people won't want to have their money in that currency because it's losing value, right? If they structurally devalue it. So China needs the US dollar to weaken. So it needs the Dixie to go down so that it can stimulate more to try and get its economy to fire back up. But it can't keep printing money unless the US dollar goes down in value, because if they do, they'll tank the value of the Chinese yuan versus the US dollar, and they'll completely destroy their economy. There's roughly $45 trillion in Chinese cash deposits sitting in a bank. And if they structurally destroy the relationship between the yuan and the USD, everyone will start to move their money out of China. Now, the problem with that is that China has really strong capital control. It's very hard to move your money out of China. So if that happens, what you'll almost certainly see is gold and Bitcoin will go through the freaking roof, because they're the only ways that people can really start to get their capital out of China in the easiest way. They can move it into Bitcoin, they can ship it overseas, they can buy gold, they can ship that overseas. Moving actual currency out is really, really difficult. So the Chinese economy is in a really, really weakened state. The yuan is devaluing against the US dollar. They need the US dollar to go lower. And so I think a lot of this is just brinkmanship, and it's all being kind of coordinated. Now, there was an event in 2016, 2017 called the Shanghai Accord, where there was basically an unofficial, like there was a G20 meeting, and then there was a side meeting where they all got together and they said, okay, what we're going to do is we're going to help the yuan get stronger against the US dollar to stimulate more global competitiveness and all of that kind of stuff. And that's why this popped up here. The consensus is that there's been something like Shanghai Accord 2.0. They're calling it the Mar-a-Lago Accord, where there's been some kind of backdoor agreement to create a structural situation in the global economy such that the US and China both get to look like strong men, right? Like they both get to play that game. But at the same time, the situation is going to lead to a devaluation or a lowering of the value of the US dollar, which then will allow China to print more, which would then stimulate more global trade, which is then going to help the economy and increase liquidity globally. Does that make sense?
Yeah, there's
a lot to unpack there.
There's a lot. No, it's also fascinating when you think through like how different stories come through in the news. And I think particularly like even the fact that no one's really talking about China. I'm sure there are non-mainstream networks and platforms and things that are focused on the China situation more so than the US. But I think like Trump as a human is just such a magnet for mainstream journalism and coverage in the news. So it's like it's easy to focus on that rather than pulling apart what might actually be happening with this relationship with China.
Yeah. So the ideal scenario here is that US interest rates come down, the Dixie comes down, US stimulus increases, the yuan USD reverts back to kind of sort of more normal levels. That allows China to print more money. That allows China to kind of save its economy, because roughly 50% of its debt is US dollar denominated debt. So they can't afford to default on that. There's all this talk about China selling US treasuries. That would be a bad idea, because that is going to then weaken their currency again versus USD. So they need USD to come down. They need this to happen. And Trump knows that too. And so there's some power plays in there for sure to give US monetary dominance over China. But it's in everyone's best interest for this to happen. Because if the Chinese yuan is allowed to collapse, right? So if this leads to a complete collapse in the yuan, that will be a major deflationary event globally. So if you remember 2008, 2009, the GFC period, right? That was a bunch of banks failing. What would happen if the second largest economy in the world collapsed? You would have a massive deflationary event, which would suck liquidity out of the entire system and would be catastrophic for the entire global economy. So no one wants that. So everyone wants to play the same game, but everyone needs to look good in the process. Okay. And so the real story here is China's current economic position and how that needs to be supported. And this then goes into also then feeding what Donald Trump needs, which is lower interest rates to be able to service the debt and all that kind of stuff. Okay. Now, what that actually means for Australia is super interesting, because however this plays out, tariffs or no tariffs, this is going to be deflationary for Australia. Why? So at the moment, the Chinese, they've got, last I checked, it was 125% tariffs against the Chinese. So the other two major trading partners for the Chinese are Australia and Europe. Now, Australia is a lot closer than Europe. And so if China gets locked out of the US economy, what's it going to do? It's going to dump all of its goods and services on Australia cheap to try and make up for lost ground. So what's that going to do? That's going to drive down prices in Australia, which is going to lead to deflation in Australia. Now, the other side of the coin again is if the the yuan collapses, again, that'll cause massive deflation. That'll cause a repricing of Chinese goods and services to be even cheaper because the yuan will have collapsed, which again is going to cause deflation as they flood the market with even cheaper goods and services. So unless the yuan strengthens against the US dollar, we're going to see massive deflation. And to the extent that the US holds tariffs against China, that's going to be deflationary for Australia. So what that's going to mean, again, if we have a deflationary environment, then governments are going to be forced to print. Now, this is a chart of and this is where the opportunity is, by the way. So this is where the opportunity is. If you can understand that the outcome of all of this is going to be more monetary stimulus, right? Because even in a scenario where the yuan completely collapses and it causes a major deflationary event, the only solution to that is going to be to try and print their way out of it, because that's literally the only way they're going to be able to get out of it. So you can see here, this is a chart of weekly global liquidity from cross-border capital. I've spoken about those guys before. Now, to give you some kind of context around this chart, so in nominal terms, global liquidity rose by 1.49 trillion last week. Last week. To a total of US 176.4 trillion. That brings the US year that brings the year to date, so from the start of the year to now, increase in the liquidity to 5.3 trillion and pushes it up to its all-time high of 175.8, past its previous all-time high. So it's at 176.4 trillion now. Now that is only going to continue to go up. Everything that we're talking about here is a setup for liquidity. Liquidity is going to pump. Again, I'll go back to it. We have deflationary signals. Velocity of money is going down. Oil prices are going down. Real inflation is going down. Dixie is going down. China's currency is on the brink. They need a lower US dollar. They need to be able to stimulate. They need a lower US dollar so they can stimulate. What does stimulate mean? Money printing. They need to be able to print more money without completely destroying the value of their currency. So they need to be able to print more money. The US needs lower interest rates so they can service the debt better. They need a weaker dollar to stimulate more economic growth. And China needs a lower US dollar so that they can afford to stimulate to print more money to stimulate their economy without tanking their currency. So all of this is intrinsically tied together. And so what that looks like is global liquidity, mark my words, is going to continue to shoot up. Now, not necessarily in a straight line, right? But we are going to see liquidity continue to rise over the next, I would say, 12 to 18 months would be my take. I think that there's been a slightly rate-adjusted cycle here in terms of the liquidity cycle, which typically lasts about 5 years. But I think we're going to see liquidity pumping into 2026. Do you have anything you want to add there? I heard you make a noise, so I thought it was...
No, I was just thinking before we moved into the, what this means for Australia section, if you're joining us live, I do want to hear, do you still have any questions about the situation, about what we're seeing from our perspective and a lot of the research is pointing towards in terms of the real story? Because I guess maybe, Goose, I'm trying to objection handle a little bit, because this is it's a different story to what I think a lot of people have come into this episode maybe believing is going to happen. Why do you think that's so different?
Why do I think it's so different? I think it's because most people don't really understand all the levers that are being pulled. They don't understand that really the whole story is like we've spoken about this before. The monetary system is broken. And by the way, go back to episode 1 of this year to understand that better. The monetary system is broken, and it necessarily requires structural ongoing increases in monetary inflation or monetary increases in liquidity in order to continue to operate. And so most of this is just gyrations to allow that kind of stuff to happen. And I think that most people just get caught up in the headlines. People get caught up in the fear. Most people get caught up in the drama. But at the end of the day, what has become true, particularly since the GFC, but if we go back to the dot-com bust, that was the first time they started tapping their finger on the money printer. It's not the first time, but that was where they started to realize that if they tapped the money printer, things would be okay. GFC hit, they didn't tap the money printer, they slammed their fist on the button and printed like hell, and they went, okay, that seemed to work. COVID happened, they started bashing the machine with a baseball bat to see how fast it could go, right? So now they've recognized that increasing monetary stimulation can paper over all of the cracks of an aging economy, declining demographics, all of these kind of things to be able to kind of keep the economy moving, because it's all I don't want to sound like a tinfoil hat, right? But effectively, the current monetary system is effectively a Ponzi scheme. You need to have more people coming into the workforce than leave it, right? So effectively, you need to, if you think about a Ponzi scheme, you have to have more investors coming in than the people are cashing out. So you constantly have enough money to be able to pay for the people going out of it, right? It's our economy is structured in the same way. And so if we don't have more people entering into the workforce than are leaving the workforce at a structural level across the whole planet, like who's going to pay for all of this stuff, right? Like who's going to pay for all of this stuff? And so the answer, they go, well, we'll just print more money, right? But then in order to do that, you need to manage things like currency valuations. You need to manage things like inflation, consumer price inflation. Now, I believe we're heading for the biggest deflationary period that we've ever seen, but I don't think it's because of this. It's going to be because of productivity, non-labor based productivity, and we can kind of get into that in another episode. So there's a question here. Can you explain why Australia is hurt by USA tariffs, but we charge 10% GST on all goods, yada, yada, yada. I don't know, Matthew, why. I don't know. I won't answer the fair question. But what I will say is I'll answer the why is Australia hurt by USA tariffs. So, and again, this is a situation that's constantly evolving and constantly changing. And so some of the stuff may be, out of date, right? By the time I finish saying this, but let's just say the US has a 25% tariff on Australian goods. What that means is that the US consumer is going to be in the supermarket looking at Australian beef, American beef, and going, well, Australian beef's 25% more than the US beef. You know what? I'm just going to buy the US beef. So what that leads to, by the way, is more deflation in Australia, because what that leads to is an economic slowdown, which is, sorry, a second part of the kind of Australia deflationary story that I should have spoken about. So tariffs in Australia are going to cause necessarily less exports from Australia. That's necessarily going to mean a slower economy in Australia. That's necessarily going to mean lower employment, lower productivity, lower output, lower revenue, lower all of that kind of stuff, which is all disinflationary or deflationary, which then means the government would have to step in and stimulate the economy through the process of money printing. Now, in with the whole China situation, again, if we're flooded with Chinese goods, even if we're not tariffed by the US, even if the US says, you know what, no tariffs, don't worry about it, Australia, we're buddies, all good. If we have a flood of Chinese goods coming into the country, they're going to compete in a much greater way with Australian-made goods and services. And therefore, that's going to then drive more deflation because people will be choosing the cheaper option. So what we have these kind of two systemic forces. One being that if there are tariffs on Australia, that's going to lead to less exports. That's going to lead to lower GDP growth. Nonetheless, whatever happens with China at the moment with the tariffs, that's going to lead to more Chinese exports to Australia. That's going to take up more of the market share of Australian products. That's going to then lead to less of the money going into the Australian economy, more of it going into the Chinese economy, which is going to cause deflation in the Australian economy. That's going to mean less jobs, all this kind of stuff. All of this points to economic slowdown and monetary stimulus. Right now, I don't want anyone to think like, oh my God, does that mean we're going into a recession? As I've said, we've already been in a recession for 2 years. This is not the start of a recession. It's the end of a recession, right? This is the point at which they go, you know what? We need to hit the money printer, right? More, right? So this is something that's been happening and brewing for the last couple of years. It's not a new thing. So I hope that explains why Australia is hurt by USA tariffs. Yeah. And by the way, I think the reciprocal is about 10%. And they moved it up to 25%, but don't quote me on that specifically. So yeah, I hope that answers. And Josh, COVID really did mess the world up. Yeah, sure, but 100%. But it actually started in 2008. That's what really messed everything up. So the opportunity here is the global liquidity is going to pump because of all of this kind of stuff, because they need to do it. So we need to lower interest rates, print more, stimulate the economy. Now, residential real estate in Australia is massive. I thought it's a really interesting chart. I pulled this out of the latest CoreLogic chart pack. Australian residential real estate is worth $11.3 trillion. It's the largest single asset class in Australia. It's more than super and it's more than stocks. In fact, it's more than super, stocks, and commercial real estate combined, which is pretty crazy. Commercial real estate is just a little over 10% of the value of residential real estate in Australia. So the thing about this is residential real estate in Australia acts like both a risk on and a risk off asset. So what do I mean by that? So when there's a high liquidity environment, there's lots of cash flowing around. That's typically and there's loose monetary policy, loose fiscal policy, stuff like that. That's typically seen as a risk-on environment where people will speculate more on assets. So we saw that coming out of COVID when there was all that stimulus. We saw that property prices went up everywhere. That was people speculating on property prices. So you get more speculation. So Australian residential real estate acts like a speculative asset because people are speculating on their ability to make money. It also acts as a risk-off asset. When everything else goes bad, right, people want to revert to Australian residential real estate. And so while the rest of the world was going into chaos with markets tanking, Australian residential real estate was just soaking up all the liquidity that's been getting created since the start of the year. So if we have a look at this, the change, the quarter-on-quarter change across the capital cities, it's all positive, right? And that's a function of Australia being a net importer of capital, massive global liquidity spiking, and Australia residential real estate being a liquidity sponge. So this is where the opportunity starts to play out, is if you can start to read through the tea leaves. You can see here as well, this is a different chart that kind of shows with a little bit more detail, but basically it's almost all up over the last period. Now, the other thing about the Australian economy is, Gabby, you've got something to say?
I noticed something. If you go back to the CoreLogic kind of dashboard that you had.
Mm-hmm.
Sorry, the first one.
The
one before that.
Or this one?
This one, yep. So if we're looking at outstanding mortgage debt compared to total value of the assets, that's only like 20%.
Yeah.
LVR, which I think is actually really crazy to think about, that that's a lot of equity in people in out there in the economy that I think maybe I don't know, it's much higher than I thought it would be. I mean, the LVR is much lower than I thought it would be. But I'm thinking through, if we're coming into a deflationary environment, it's worse for that debt, right? Like debt becomes more expensive. So that's not a great thing for people who are holding this debt.
Yeah, sure. But the system that we're in doesn't allow for deflation, because you got to remember the government holds lots of debt as well. And so in a deflationary environment, debt is more expensive tomorrow than it is today. And so what would happen is that would make the debt unsustainable, because you're right, the LVR on Australian residential real estate is bugger all, right? But there's lots of others, 250% debt to GDP in Australia, and so all of that would start to really put the collateral of the country at risk, right? And so they can't afford. This is kind of the punchline. They can't afford deflation. No one can afford it, right? And so the answer is going to be monetary inflation to keep stimulating the economy in their target band of 2 to 3%, right? And that's the goal. Yeah. Okay. So. But yeah, I think it's a really great point that you pointed out. Like the level of debt on Australian residential real estate is bugger all. Yeah. Now, Australia is already trending disinflationary, and we've already covered. So if you're in a disinflationary environment, what does that mean? That means the government needs to move into a stimulation phase rather than they move to a quantitative easing, or an easing, not even necessarily quantitative easing, but an easing cycle versus a tightening cycle, which is exactly what's happening in Australia. So we're trending disinflationary. So the official number is that we're at 2.4%, but we know that those baskets are manipulated. If we go back to the Trueflation numbers for the US, it was 1.34% versus 2.8%. So you can kind of draw your own conclusions from that. But I think our real inflation rate is probably in the ones, not in the twos, in a very practical sense, because this is using a manipulated, lagging data that's not real time. Yep. But Australia is, yep. So Australia is trending disinflationary at the moment, which again points to us moving deeper into a liquidity and stimulation cycle. Now, there was a question in here about, do you agree with what the market is pricing in for RBA rate cuts over the next 12 months? So let's talk about that now. Now, this was taken from yesterday, and I note that the numbers are different today. So let's take this as an indication, right? But yesterday, the market was pricing in a 77% chance of a 75% basis point, or a 0.75% interest rate cut at the next RBA meeting, which is, I think, May 20th. Don't quote me on that. Now, today, it's something more like a 77% chance of a 50 basis point cut. Now, whether it's going to be 75 basis points or 50 basis points, it looks more and more likely that what we're going to have is interest rate cuts on the horizon. Now, partly driven by the fact that we have trending lower inflation And if we get too low, that's going to be negative for the country. And look, by the way, all of the inflation has been manipulated anyway, because we've just been immigrating. Had open door immigration policy and lots of government spending. So the fact of the matter is the economy is weaker than it actually is. I think Lindsay mentioned that earlier. That he said immigration has hidden a lot of the flaws in the Australian economy, and he's absolutely right. So the situation we have is we've got a distorted Australian economy that's way weaker than anyone's prepared to admit, and so they're getting to the point where they're going to have to stimulate, or else something is going to break. And hence why, and interest rates are only one way to create stimulation, because that creates an increase in credit capabilities, which allows credit creation as a function of monetary creation as a function of credit creation. And if we take the ASX 30-day interbank cash rate futures implied yield curve, which is a fun way of saying what does the market think that the interest rate is going to be in the future, this is pretty interesting. Now, again, I'll note that this was as at market close on the 9th of April. So if you have a look today at the ASX 30-day interbank futures, you're going to note that it's as at market close on the 10th of April, and it is different. I've already looked at today; it is different. But the fact that it changes every single day based on the volatility of the stock market is why I'm not really that worried about changing it. What we can see here is that it's implied that we're going to have a whole bunch of rate cuts through 2025. Now, is it going to be 1 or 2 or 3%? The current cash rate is 4.1%. Typically, the cash rate is 0.055% higher than the implied yield on the cash rate futures. So this would imply, based on this chart, a cash rate of approximately 2.79% by the end of the year. Now, could that be a little higher? Sure. But we may get 2 or 3 or 4 25 basis point cuts this year. We'll see. But the point here is this looks like very strongly the market is pricing in interest rate cuts into the near term future, which again is going to be part of a stimulation phase.
Yeah. So what does that mean for asset prices?
Basically, that means asset prices go up because increase in liquidity means typically hard assets, the harder the assets, the more they go up, is going to be, so real estate, yes, Bitcoin, yes, stocks, yes. But actually, if we just kind of go back to this, if you want the best risk-adjusted return, residential real estate in Australia is going to be the best option, because liquidity is going to flow into this market, and there's already too much demand for this market. And so what we're going to see most likely is massive drive up in prices in Australian residential real estate over the next 12, 24, 36 months, because we're moving into an easing cycle where we're going to have increased monetary stimulus, lower interest rates, more deflationary pressures from China, which is then going to force more monetary inflation and more monetary growth. So there's a bit of a summary here, and then we can kind of stop sharing and we can kind of talk and answer questions and stuff. Tariffs generally equal deflation because they slow down trade, and that ends up being a bad thing, and that means economies contract, and that causes deflation. Financial conditions are easing. Liquidity is rising. Inflation is already rolling over pretty much everywhere, and central banks are acting behind. They're using lagging data, manipulated data. The velocity of money is slowing. That's a deflationary signal. The recession risk has already been priced in. You can kind of see all that in the markets with how much the markets have been tanking over the last little bit. The RBA is currently set up to cut again, and real estate's responding to sentiment and liquidity pumping into the market already. So that's kind of the story here for me as I think about this. I look at this is my kind of, how do I make sense of what's happening with all the tariffs, and what does that mean for property and our portfolios? So
awesome. I
cool.
will stop sharing your screen.
Perfect. So I'd love to hear from you, Gabby, or anyone else in the chat if that all made sense to you guys, because there was a lot to unpack there. Because what I tried to do, and I don't how effectively did I do it, is going to be judged by everybody else. But what I tried to do is show that the kind of macro setup is that the US is facing a sovereign debt crisis. They need to lower interest rates. They need to weaken the US dollar to drive economic stimulus. They need to lower interest rates so they can afford to pay back the debt. They need China also needs the US dollar to come down so they can afford to stimulate more, to print more money, to stimulate their economy. The US ultimately wants the Chinese economy to go well because it's going to stimulate global trade, and it's going to be less deflationary, and we're not going to end up in a deflationary spiral that everyone's going to struggle to get out of. And so all of this is kind of brinkmanship to kind of get everyone to that position. And Australia is on the receiving end, right? Australia is in this very unique and interesting position where basically we're going to get hit with more deflationary forces than inflationary forces from any of this. And what that's going to result in is more stimulus. So global liquidity is already rising, even as China prints more money. So let's say the value of the US dollar keeps coming down, and China's able to print more money without tanking their currency. What's that going to mean? That's going to mean more money flowing into Australia, because that money is going to flow around into the global economy. It's going to flow into the Australian real estate market as well. So the global liquidity is rising, financial conditions are easing, and Australian residential real estate is it's a sponge for all of that kind of stuff. It just soaks it up because it acts as both a risk on and a risk off asset. So it doesn't just perform well when things are good, it also performs well when things are bad. And that's a very unique position to be in. So we're kind of in this like little wedge of the world where it's like, all right, tariffs, no tariffs, China, like cool. What's going to happen in Australia is more monetary stimulus. We're going to soak up more of the global liquidity that's pumping around the rest of the world. That's going to get sucked up into the Australian residential real estate market. That's going to cause prices to rise. And that I'm very, very confident about. And that's, I think, what people are missing by this, because consumer confidence in Australia dropped by about 5% in the last week because everyone's freaking out. It's like, oh my God, markets are crashing. Are we heading for a Great Depression? We're not. That's not happening. Like what's happening is more liquidity, more pumping. That's going to flow into the Australian residential real estate market. Now, by the way, just as a sort of a little byline to this, not every market is going to perform the same. When there was an interest rate cut in February, what happened to the Sydney market is the Sydney market popped up. There was like you can go and look literally from the day after the interest rate cut in February, the Sydney market popped up and then it's popped back down again, right? It's actually fallen to below where it was when the interest rate cut was announced. Right. And so you have some markets are more volatile than others. And so you still need to get your positioning correct to make sure you know where is the capital going to flow in the market. And this is where we start to look at, how does money move through the Australian economy? And if you want to know more about that, go to the liquidity episode that we did to talk about that. But there's more and more movement around, and we need to think about that. So we need to think about where is the money going to flow to in the Australian market, and how do we capitalize on it in the best possible way?
Yeah. And I guess like in that situation, right, it's people who, there's always demand for certain levels of property, like to certain values and certain bands, but people who weren't previously able to afford it, with rates coming down, it's like they bump into that, like, now I can afford this asset that I've been wanting but I haven't been able to afford, and so that kind of pushes up the pricing, right?
Yep. Yeah, and that's why the middle band of Australian property is actually the most stable, least volatile, best part to get into, because you've got the kind of like, you've got the $1 to $3 million price point, which is like right on the edges of people's affordability. Because when people are buying $10 million homes, they're not buying them with a loan; they're paying cash, right? So you get these kind of like $1 to $3 million ish kind of price range where people are really stretching their capabilities to be able to afford those based on their incomes. And so if interest rates go up, they can't afford those properties. And so demand for those properties goes down, and people, they move lower. They go, okay, well, instead of $1 million property, maybe I'll get a $700,000 property or a $600,000 property. Now, what happens as well is and then also on the bottom end, a bunch of people get priced out from even getting into $300,000 properties. Then as interest rates lower and credit capability, credit access increases, the people who couldn't afford to buy the $300,000 properties, now they can buy 300, maybe even 400,000, so they can get into the market. And the people that could buy $300,000 and $400,000 properties, they can now afford to buy $500,000, $600,000, $700,000 properties.
Yeah,
and so you get this kind of movement. Yeah, it shifts up. Right. But where you actually have consistent perpetual demand is in that kind of mid range, which is, as at today, broadly 400,000 to 600,000, right? Is it kind of like a general kind of indication, is where you have like this perpetual demand, like the kind of middle of the range.
Just something that you touched on just when you were going through the real estate section. I think it's really important to remember to focus on risk-adjusted returns in this whole environment, because to your point, the best asset for risk-adjusted returns potentially is real estate. And so there's a question from Josh earlier that I'll get your opinion on, but he said, part of my take on all this tariff stuff was to shake liquidity out of stocks and into more stable and safe assets like US bonds. And so, Goose, I don't know if you have an opinion on that strategy, but just like thinking through like what a safe asset would be and how that marries up with like the potential return, and then making sure that you're factoring in the risk adjusted return on your choice of asset classes.
Well, I mean, the first things first is like there's nothing riskier than a US bond, right? So like US bonds or pretty much any bonds have had negative real rates of return for a very long time. So what that means is that inflation is higher than the yield that you would get from the bond. So basically, you get net negative real returns. So I think bonds are trash. Basically, that I would never buy a bond. Basically, um, so I don't know if any of this was specifically designed to shake liquidity out of the equity markets. I don't think that's. I think equity markets crashing is a byproduct of a bigger game they're trying to play. That is going to kind of force governments to act in a certain way, which is interest rates and liquidity. And I think that equities markets will bounce back. So I don't think there's any kind of like real risk there. Yes, liquidity did get sucked out of the system through things like margin calls and a whole bunch of other things. When VIX shoots through the roof, liquidity gets sucked out. But going back to your point about risk-adjusted returns, I think that's the most important thing to consider, right? So, if we go back to COVID in Australia, where there was massive amount of monetary stimulus, what that meant was that like something like 96% of suburbs in Australia went up, which is just insane. And we said at the time that a lot of people are going to be buying properties and they're going to feel the pain in a couple of years' time when they find that there was no fundamentals around those assets, right? And so it can be very easy to go further out on the risk curve, looking for deals and stuff like that, and then end up underwater because you haven't appropriately assessed the risk, which is why it's very important to make sure that you still make astute, fundamentally driven investment decisions. So from my point of view, it's like, I love to make money, but I hate to lose money. So that's why I'm comfortable with options trade, or not trading. We don't trade them per se, but like that's why I'm comfortable investing in options, because I like the ability to get leverage and I like the ability to magnify my returns. But I'm terrified of the idea that someone could margin call me if we got loans to buy equities, right? So like I would never want to be margin called. You can't get margin called on an option. And so the way that I think about it is like, how do you make the most amount of money with the least amount of risk? And, I'm not sure if this answers the kind of question around like money getting shaken out of the equity market, moved into bonds, because bonds aren't safe. Bonds are high risk. Bonds are shit, basically, right? So what I can say is true, though, is that Australian residential real estate performs like a risk on and a risk off asset. And that's very, very unique. Now, when you look at the global landscape of things, the investable universe over the last week or so, what's very interesting is that Bitcoin, whilst it did have price declines, held up very well compared to things like equities. Now, that to me is an indication that Bitcoin is moving from a risk on asset and it's in a transitory phase to something more like a risk off or some kind of risk on, risk off asset, kind of like real estate in Australia. Now, I'm not here to kind of shill Bitcoin, because I think the real opportunity here is in real estate right now. I think that's the real story. So I think that's where you're going to get the best bang for your buck, as long as you can play the cards right. But yeah, I think like looking at total return is kind of a mug's game, right? Because what's your total return on buying a $1 lottery ticket if you win $1 million, right? It's massive. What's the chances of that happening? Like most likely you're just going to lose your dollar. So it doesn't really matter. What you want to look at is what's the risk-adjusted return? What's the probability of you losing that money versus the probability of you making a gain? Does that help?
Yep, it does. Sorry, I'm reading through the questions.
Great.
Sorry, something I actually just thought that would have been good to touch on.
Mm-hmm.
Have you thought much about superannuation in this whole week?
No, but I have lots of thoughts on superannuation. Do you have a question?
No, it's just I was reading about, obviously, because a lot of people have super, right? In Australia, there's mandatory super, so we all have a super balance, and a lot of the super funds are invested in like the S&P 500 and the stock market generally. So I think a lot of people have been experiencing pain in the stock market volatility this week in terms of their super. So I've seen people like concerned about, do I try and like take my super out and do something else with it? Do I try and do like the government strategies of trying to buy a house with it? Do I set up an SMSF to try and do it that way? I don't know if you've thought about this at all this week, or if you have any thoughts now.
Yeah, I mean, I hate super. This is my broad thought. I think it's ridiculous. Like, I think that the most super funds underperform the real inflation rate, right? So you're not actually getting
Mm.
ahead. You're kind of preserving your money,
Yeah.
ish. So I think most industry super funds, they get a 10% return. It's like, yeah, but you need 12, 14% to kind of tread water. So, okay, like cool, it's better than keeping it in cash, fine, but it's not very good. And so, yeah, I think people should be concerned about their super. And by the way, let's say you take your money out of super, out of an industry fund and put it into an SMSF. By the way, not tax advice, not financial advice. We can't give advice on
Not
super. These are just
financial
these are just the opinions of me, right?
Yeah.
Let's say you take the problem is in Australia it's mandatory super. Okay, so even though I think it's stupid, you have to have it. Okay, so then how do you make the best of a bad situation, right? Because it'd actually be much better if that money just went into your own pockets. You had more control. You could do more with it, make better returns. But you can't. So, and why can't you? Because they know that they can't afford to keep paying pensions because there's less people coming into the workforce than there are people leaving it, right? So they already know it's a Ponzi scheme. That's why they put the super system in place, because they knew they weren't going to be able to pay pensions. So, all right. So don't rely on your pension and don't rely on your super. Got it. So if you then want to take your money out and put it into your self-managed super fund, what do? Hey, look, maybe you want to invest in equities. Maybe you want to invest in, I don't know if you can invest in cryptos or whatever. You can invest however you want. You'll have more control for sure. And for me, personally, that would be better. For some people, that's not going to be better. So don't do it, right? So this is not advice. But the problem is,
I would say go back and watch episode 3 because we dove into a lot of like how to approach investing this year.
Totally. So what I was going to say was, let's say you do move into an SMSF and you go, okay, cool. I'm going to invest in property because I believe in property and I think it's going to be awesome. I think it's going to give me the best risk-adjusted return, less volatility. I'm going to be able to sleep better at night. I don't need to worry about stock market crashes. I don't, because that's the problem is stocks and equities, they're a different place on the risk curve. Like their volatility is through the roof. And by the way, companies can completely fail. Last time I saw it, a house doesn't fail. It just sits there, right? So it's not the same as owning a part of a company. It's a real asset. It's a hard asset, right? It's a scarce, desirable, hard, tangible, physical asset. It's not someone can issue more equities. They can issue like stocks. Some people call stocks hard assets. They're not. You can just print more of it. Like, so they're hard-ish because they tend not to just do that willy-nilly, but they still can. But if let's say you go buy an investment property in your self-managed super fund because you think that's going to be the way to go, that's cool. But like, there's so little you can do with it. You can't refinance the equity to go buy another one. You can't build a portfolio. All you can do is just like play some chips and good luck and hope for the best, right? And so I don't like super. I think people should be concerned about their super. And I think that whilst we have mandatory super, you should do everything you can to make the best of the situation, whatever that is. And then you should aggressively seek to not have to rely on that crap by building a property portfolio and building an investment portfolio outside of super where you can control your money, where you can influence the returns and you can maximize your potential to get to where you want to get to. You want to be able to set yourself up for retirement in spite of super. You want to pretend like super doesn't exist. All right. And you want to get yourself to a place where you can retire without your super, and then your super is just a bonus. Because you can't get that until God knows however down the line anyway, right? So, you know.
Yeah.
Great comment there, Liv, by the way.
It seems like a lot of people agreeing on your opinions on super. I think the super conversation's interesting, and it's actually frustrating to think through because I think through all the like people approaching retirement, or maybe they're in retirement already, that all they've had is their super, and it's maybe not enough, and it's like, it's not right anyway.
100%. And yes, Josh, the retirement age does continue to grow. And so they keep kicking a can down the road, and you can't access any of your capital. And so you may want to retire at 50. Well, good luck if you can't access your super until you're 65. And what if they change that to 70? So I think it's, I never want my money to be a prisoner. By the way, Blake put a really great comment in here. He said, would it be accurate to quote Rich Dad, when fake money enters the system, real money goes into hiding? Yes, that is a great quote. That is exactly. So when fake money enters the system, real money so when fake money enters the system, it flows into real money is actually a better way to think about it. Because what is money? Money is a mechanism to transport your economic energy through time and space. The degree to which you can do that effectively is the degree to which it is good money, right? And so, yes, real estate can be monetized, and you can turn it in that fashion because you transport your economic energy in that way, and so can other things. But you're right. When fake money when magical fake, fiat money gets printed into the system, it flows into hard assets. where there's real tangibility to it. Now, we've gone into this kind of stuff before. So gold has transportability issues, divisibility issues, verifiability issues, all that kind of stuff. Bitcoin is highly verifiable, highly portable, highly, all of its great characteristics. Real estate is awesome. It's not very portable, right? It's not very portable. It's not very divisible. It's not very fungible. But guess what? It's a real scarce, desirable asset and has a tremendous amount of real utility. And so absolutely, as liquidity grows, it's going to flow into scarce, desirable, real hard assets. So you will see things like real estate in Australia, because by the way, real estate in the US and real estate in Europe and real estate in other parts of the world are very different. You will see real estate in Australia pump. You will likely see Bitcoin pump. You'll probably even see gold pump as well. And because of you probably see equities pump as well, but again, there's way more volatility in there because there's a completely different level of risk associated with companies. So,
yeah.
Anyway, we are about at time. What do
We are
you
at
think
time.
of this episode, Gabby? Do you think this was useful?
Yeah, look, I love when you get all charty on us. I had a thought as well, just quickly. If you do like that kind of content, can you let us know? Because I would love to know, like, we can prepare more of this stuff, particularly around, like, there's a lot happening in the news and the world right now. So if it's helpful to do that, we are also very busy people, so we will do our best to kind of pull valuable episodes together like that. Otherwise, if you do follow Raoul Pal and the team at Real Vision, they do really great content with these kind of charts as well. And they're global macro investor. A lot of their charts are from that, so they're very big on
so
really great.
Why don't I give a few sources of things that I look at to
awesome.
kind of get this information.
Yeah.
So Real Vision, Raoul Pal, global macro investor, they're all great sources of information around all this kind of stuff. By the way, if you want to understand the most foundational two books that kind of stimulated my thinking around money, it was The Bitcoin Standard, actually not for the Bitcoin piece, but for the monetary history piece. The Bitcoin Standard by Safedine Moose, The Price of Tomorrow by Jeff Booth. So those two books have been fantastic. There's a YouTube channel called Invest Answers. Great content on there. He's he does lots of technical stuff as well. Raoul Pal, Real Vision. I always watch Kathy Wood's ARK Invest in the Know series because she does lots of great stuff. That's where I was listening about the velocity of money changes. Where else? Michael Howell's newsletter, Capital Wars. That's where I get most of the global liquidity stuff from. And they're kind of probably the main ones. And then outside of that, I then just go and troll through charts and start to look for things myself. But there's lots of great resources out there that you can access to. We had one final question that we wanted to get in there. What are the data sources to understand how much my salary should increase in order to grow ahead of currency debasement?
As an employee.
As an employee.
Yeah.
As an employee, what are the data sources? We covered off the hurdle rate stuff a couple of episodes ago, so it might be worth going back to that, Josh. I'm trying to think about how to inform you on data sources. So RBA produces information on M3 money supply and M2 money, M3 and M0, M1 and M3 monetary supply. So that would be the first place to look and have a look at those growth. By the way, you can look up those charts in other places, trading economics. That would be the first place to look because really what you're trying to outpace is monetary debasement. So that would be the first one. And then if you go back, I would say go back over the episode where we talk about hurdle rates. Do you remember the name of that episode, Gabby?
It has the words hurdle rates in the title.
Yeah, I think it's like the thumbnail is like how to win at investing, right? And so if you go back to that episode, Josh, then you'll probably start to you'll be able to then critically think, okay, well, like where am I going to find this information? But it's mostly a combination of monetary inflation, tax, risk adjustment, that kind of ladders up to get to your hurdle rate. So I hope that helps.
Awesome. Cool. Lots of great questions and comments coming through at the end. So thank you so much for joining us live. If you're not here live, we still appreciate you checking this out because I think if you've gotten value, and I think hopefully we've covered a more understandable approach of what's actually happening in the economy and how you can maybe think about taking action or not taking action in the next weeks or months or sometime this year. If you've gotten value, do share this with someone that you know and think would also get value. It means a lot to us for you to share this episode around because, again, like we've been saying, not enough people talk about these kind of conversations, and it is hard to find this kind of information out there. So if you've appreciated it, share it with someone you love. Goose, anything else you want to add?
Nope, I think it's
Nope.
awesome. Thank you so much for everyone who came. Apologies for all the people that we didn't get questions, who asked questions that we didn't answer the questions. Apologies for that. We'd love to stick around, but I've got to run because I've got to get to another meeting. But there's a bunch of questions in there that apologies that we didn't get to answer all of them. And thanks so much for all of your engagement today. It's been awesome.
Awesome. Thanks, guys. See you next week.
Thanks. See you. Bye.